Let's talk about dividend investing. It's a huge topic online, right? You've got one camp swearing it's the key to passive income, and another calling it a total financial trap. So where's the truth? Well, we're going to cut through all that noise, break it all down, and figure out what's really going on with dividend stocks. You've probably heard this one before. It's the big promise. The number one reason people get so excited about dividend stocks. The idea that you buy a share, sit back, and the company just sends you cash. It feels like a reward, a little bonus for being an owner. Who wouldn't want that? But what if it's not that simple? What if that whole free money thing is actually a misunderstanding? What if the very thing that makes dividends so appealing is also what makes them so dangerous if you're not careful? That's the big question we need to answer. So here's our game plan. First, we're going to debunk the most common myths out there. Then, we'll get into the real benefits and follow that up with the hidden risks you need to know about. And finally, we'll wrap it all up to help you decide if this strategy is actually right for you. All right, let's dive right in. It's time to separate fact from fiction. We're going to tackle some of the biggest beliefs about dividends that can trip up even experienced investors. So let's go straight for the jugular. Myth number one. This idea that dividends are some kind of bonus cash, an extra reward on top of your investment. I mean, it feels fantastic when that money hits your account, but is it actually free? The reality is a little more like basic accounting than magic. A dividend doesn't create new wealth from thin air. It's really just a transfer of value. The company takes cash out of its bank account and puts it into yours. So the total value hasn't changed. It's just shifted from being inside the company to being in your pocket. Let's make this super simple. Imagine you own one share of stock and it's worth exactly $100. The company pays out a $1 dividend. Instantly, the value of the company drops by that dollar, so your stock is now worth $99. But you have $1 in cash. So what's your total net worth? Still $100. You're not any richer the moment that dividend is paid. This is so important to understand. All right, on to myth number two. The idea that if a company pays a dividend, it must be a safe, stable investment. It kind of makes sense on the surface, right? If a company has enough extra cash to give it away, things must be going great. Well, not so fast. This is what investors call the high yield trap, and you have got to watch out for it. Sometimes a super high dividend yield isn't a sign of a great deal. It's a massive red flag. It often means the stock price has tanked because investors think the business is in deep trouble and that dividend is about to be cut. Just remember, a dividend is only as safe as the company that's paying it. Okay, next up, myth number three. This is a big debate you see online. Dividends versus share buybacks. A lot of investors prefer dividends because they're tangible. You can see the cash land in your account. It feels real. But does that automatically make them better than buybacks? This chart really clears things up. With a dividend, boom, you get cash, but you also get a tax bill right away. Share buybacks are a bit more stealthy. The company buys its own shares off the market, which reduces the total number of shares out there, making your slice of the pie a little bit bigger. And the best part? You only pay taxes on that gain when you decide to sell. So you can see how for some people, buybacks can be a much more tax-efficient way to build wealth over the long haul. And for our final myth, this is a big one. It's the stereotype that dividend stocks are just for your grandparents. Slow, boring companies that are only good for little income. The idea that you have to pick one. You can have growth or you can have dividends. But is that actually true? Spoiler alert, the data tells a totally different story. Check this out. The real secret sauce isn't just any old dividend, it's a growing dividend. The research is pretty clear on this. Companies that consistently increase their dividend payments have historically delivered much better total returns than companies with flat or stagnant dividends. Why? Because a rising dividend is one of the strongest signals you can get that a business is healthy, confident, and growing. And if you want a killer real-world example, just look at McDonald's. Let's say you invested $100,000 in McDonald's stock back in the year 2000, and you just let those dividends automatically reinvest. Today, that investment would be worth over $1 million. I mean, that's not just income, that is life-changing growth. And here's the really wild part. A whopping 40% of that massive $1 million return came from the dividends themselves, just being reinvested and compounding over time. That proves that dividends can be an incredibly powerful engine for creating wealth, not just a way to get a little passive income. So now that we've busted those myths, we can start to build a much clearer picture. Let's talk about the good stuff. What are the real, legitimate reasons why a smart dividend strategy can be so powerful?
The real magic here is a combination of things. First, these are often very stable, mature companies with predictable businesses. Think of a company like Coca-Cola. Second, that growing dividend we talked about acts as a huge signal of strength and confidence. But honestly, one of the biggest benefits is psychological. Getting that regular cash flow can make it so much easier to stay calm and stay invested, especially when the market gets rocky.
But of course, it's not a free lunch. To be a smart investor, you have to look at the other side of the coin. So let's talk about the hidden risks, the things that can really bite you if you're not paying attention. Yeah, it's so important to know the potential downsides. We already talked about the high yield trap, which can lure you into a struggling business. There's also an opportunity cost. Every dollar paid out as a dividend is a dollar the company can't reinvest to grow faster. Then there's the tax hit. And maybe the most dangerous risk of all, that false sense of security. A dividend can make you hold on to a failing company for way too long. All right, we've gone through the myths, the real benefits, and the hidden risks. That brings us to the single most important question. How do you figure out if dividend investing is the right move for you and your financial goals? This really breaks it down nicely. If you're someone who values a steady income stream, maybe you're nearing retirement, or you just want to add some stability to your portfolio, then yeah, this could be a fantastic strategy. But on the other hand, if your number one goal is just maximum all-out growth, or if you're in a high tax bracket, you might be better off with companies that reinvest all their profits. There's no one-size-fits-all answer here.
And that really brings us to the final, critical question you need to ask yourself. Are you buying a great, healthy business that just so happens to pay a dividend? Or are you just chasing the payout? Are you investing for income or just blindly following the yield? Understanding that difference, well, that's the key to making this strategy work for you